You might assume that owning a gold mine means owning a machine that prints money. Gold is trading near record highs, central banks are buying it by the ton, and every ounce that comes out of the ground is worth more than it has been in living memory. So the mine should be worth a fortune. That's the logical assumption. It's also wrong, or at least dangerously incomplete. Some of the richest gold deposits on Earth are sitting inside companies that are drowning in debt, fighting their own governments in international courts, or watching soldiers land on their property to physically carry away their gold. The price of the metal has almost nothing to do with whether the mine that produces it is actually a good business. Understanding why reveals something much bigger about how extraction industries really work and about who actually owns the wealth sitting under the ground. Start with the number everyone quotes, the gold price. In 2026, gold is traded above $4,000 an ounce, at times pushing toward $5,000, a level that would have sounded like a joke a few years ago. If a mine pulls 1 million ounces out of the ground in a year, the simple math says that's $4 or $5 billion of value created. That's the version of the story that gets told at investor conferences and in breathless headlines about the gold boom. It is also almost useless for understanding whether owning that mine makes you rich or bankrupts you. The number that actually decides the outcome is a quieter one, buried in the footnotes of mining company earnings reports, the all-in sustaining cost, or AISC. It's the industry's way of answering a simple question: what does it really cost, all in, to get 1 ounce of gold out of the ground and keep the mine running long enough to get the next one? Not just the diesel for the trucks and the wages for the crew, but the cyanide and cement for processing, the capital spent drilling new tunnels to replace what's been mined out, the environmental bonds, the corporate overhead, the insurance, the security. Add all of that up, divide by the ounces produced, and you get the true cost of a single ounce of gold. Across the industry, in 2026, that number sits somewhere between roughly $1,500 and $2,000 per ounce, depending on the mine, with the median producer landing around $1,700. Some of the best-run, highest-grade mines get that cost below $1,300. Some of the worst-positioned ones creep past $2,000. That gap between AISC and the gold price is the entire business. It's not a rounding error. It's the difference between a mine that mints cash and one that is quietly bleeding out while gold makes headlines for hitting new highs. Here's what makes 2026 unusual. Gold prices have risen so fast that even mediocre mines are printing extraordinary margins. Industry-wide, producers are pocketing something like $2,800 of profit on every ounce they dig up, the widest spread the industry has ever recorded. That sounds like the golden age for anyone who owns a mine, and for a narrow window, it is. But that windfall creates a problem nobody who only looks at the gold price ever sees coming. It makes the mine a much more attractive thing to fight over. To understand why, you have to unlearn the first assumption people make about mining, that when you own a mine, you own the gold. You don't. Almost nowhere on Earth does a private company own the mineral rights outright, the way you might own the furniture in your house. What a mining company actually owns is a license, a legal permission granted by a national government to extract a resource that the country's constitution usually declares belongs to the state and its people. That permission comes with conditions attached: taxes, royalties, a percentage of ownership handed to the government for free, employment quotas, environmental obligations, and every one of those conditions can be renegotiated. This is the part that gets glossed over in every glossy mining company presentation. The gold in the ground is not the asset. The legal right to take it out is the asset, and that right is, by design, temporary, revisable, and held at the pleasure of a government that had nothing to do with finding the deposit, building the mine, or spending the $1 billion it usually takes to get gold flowing. For decades, this arrangement worked reasonably smoothly, mostly because gold prices were low enough that governments had little appetite to pick a fight over a resource that wasn't generating much revenue anyway. But when the gold price triples, the calculation changes on both sides of the table. The mining company, having sunk a decade and $1 billion into building the operation, wants to capture as much of that windfall as it can before costs catch up. The government, watching a foreign company export plane loads of value that used to belong, in principle, to its own soil, starts asking why its cut of the deal was negotiated when gold was worth 1/3 of what it's worth now. That tension is not hypothetical. It is currently playing out at one of the largest gold mines in West Africa, and it shows exactly how a world-class deposit deposit can turn into a 2-year hostage situation. The mine is called Loulo Gounkoto in the southwest corner of Mali, near the border with Senegal. It has been in continuous production since 2005, run by the Canadian mining giant Barrick, which owns 80% of it, with the Malian state holding the remaining 20% for free, a standard arrangement in many resource-rich countries where the government takes a guaranteed stake without paying for it, in exchange for granting the mining right in the first place. For nearly 2 decades, Loulo Gounkoto quietly did what mines are supposed to do. It dug up gold, exported it, paid taxes, and funded a meaningful share of Mali's national budget. Gold accounts for something like 80 to 85% of the country's export earnings, which tells you how much a single mining complex like this one matters to an entire nation's finances. Then, in 2023, Mali's military government rewrote its mining code. The new rules increased the state's stake in mining projects and raised the tax burden significantly. Barrick, like every other foreign miner operating in the country, was suddenly negotiating under different terms than the ones it had built its entire investment case around. Negotiations dragged on. In December of 2024, the Malian junta issued arrest warrants for Barrick's own CEO and the mine's general manager, accusing them of financial crimes. Gold shipments from the complex were blocked. In January of 2025, the government physically seized roughly 3 metric tons of gold from the site, worth about $245 million at the time, and transferred it to a state-owned bank. Barrick suspended operations rather than keep producing gold it wasn't allowed to sell. Watch what happens next, because this is the chain reaction that defines the entire industry, not just one mine in West Africa. A rising gold price increases the value of what's in dispute. The increased value hardens both sides' positions. The hardened positions escalate into legal and physical confrontation. The confrontation halts production, and halted production is catastrophic for a mining company in a way that's easy to underestimate, because a mine that isn't running is still spending money. Barrick's own CEO said the company was burning through $15 million just to keep the suspended Mali operation intact, paying salaries, maintaining equipment, preventing underground infrastructure from flooding or collapsing, while producing zero revenue. That's the trap. The fixed costs of a mine don't pause just because the gold does. By April of 2025, Malian authorities shut down Barrick's office in the capital and threatened to place the entire mine under a court-appointed administrator if the company didn't reopen and pay disputed taxes. In June, a Malian court did exactly that, handing day-to-day control of the complex to a state-appointed administrator over Barrick's objections. Then, in July, the story took its strangest turn. Government helicopters landed unannounced at the mine and hauled away another metric ton of gold, reportedly for sale by the newly installed administrator. Barrick said it didn't even know where that gold went. This is worth sitting with for a moment, because it's the clearest illustration you'll find of the gap between what people assume mine ownership means and what it actually is. Barrick had spent decades and billions of dollars building, operating, and expanding this complex. It held 80% legal ownership. And for a period of months, it did not control its own gold, its own mine, or its own personnel, some of whom remained detained. Ownership, on paper, and control, in practice, turned out to be 2 entirely different things. The dispute finally ended in November of 2025, after nearly 2 years, with a negotiated settlement. Barrick agreed to pay Mali approximately $430 million to resolve all outstanding claims. In exchange, Mali dropped every charge against the company and its employees, released the detained staff, ended the provisional administration, and returned operational control, along with the roughly 3 tons of previously seized gold, worth about $400 million at that point. 3 months later, in February of 2026, Mali renewed Barrick's operating permit for another 10 years, and the company now expects to produce somewhere between 260 and 290,000 ounces from the complex in 2026 alone. Notice what actually happened economically once you strip away the drama. Barrick didn't lose the mine. Mali didn't nationalize it. Nobody actually wanted the standoff to end in disaster because both sides needed the other. Mali needed Barrick's expertise, equipment, and export revenue. Barrick needed Mali's permission to keep operating one of its most valuable assets. What actually happened was a repricing,
a very expensive, very public negotiation of how much of the windfall from higher gold prices would flow to the country instead of the company. The $430 million settlement was in effect the market price of restoring the relationship. This is the pattern to watch for across the entire gold mining industry, not just in Mali. It's happening in various forms in Ghana, in Burkina Faso, in Panama, in Indonesia. Anywhere a foreign company controls a resource a government now considers underpriced relative to current market conditions. The healthier the gold price looks on the surface, the more pressure builds underneath it, because higher prices don't just make mining more profitable, they make mining more contested. That contestation is the overlooked cost nobody puts in the glossy annual report projections. When people model the economics of a mine, they build a spreadsheet: reserves times grade times recovery rate minus AISC times the gold price equals profit for the next 15 years. It's a clean, satisfying calculation. It also assumes something the Loulo Gounkoto story proves is never guaranteed, that the operating environment, the tax rate, the ownership split, and the government's patience will stay roughly constant for the entire life of the mine. In reality, sovereign risk isn't a footnote. For a resource this valuable, in a country this dependent on it, sovereign risk might be the single biggest variable in the entire investment. There's a second layer of hidden cost that compounds this one, and it applies even to mines that never make headlines. Gold doesn't just sit there waiting to be dug up cheaply. Every mine follows a depletion curve. The richest, easiest to reach ore, the high-grade stuff close to the surface, gets mined first because it's the most profitable. What's left behind year after year is progressively lower grade and harder to access, meaning the cost per ounce tends to rise over the life of a mine, even before you account for inflation, labor costs, or energy prices. That's part of why industry-wide AISC has climbed roughly 50% over the past 6 years. A mine that looked wildly profitable on its opening day can look mediocre a decade later, purely because the easy gold is gone, and what remains costs more to extract, even though the total pile of gold under the property hasn't changed on paper. Put those two forces together, rising extraction costs as a mine matures and rising political and fiscal pressure as it becomes more valuable, and you get the real shape of gold mining economics. It isn't a straight line from gold in the ground to money in the bank. It's a decades-long balancing act between a shrinking pool of easy value and a growing appetite from everyone with a legal claim to a piece of it: the host government, local communities, labor unions, environmental regulators, and in an increasing number of cases, the courts. So what's the realistic range of outcomes for someone who actually owns a gold mine today? At the optimistic end, you get exactly what's happening across much of the industry in 2026. Gold prices rising faster than costs, first quartile lines locking in AISC below $1,400 an ounce, and margins near record highs, funding dividends, expansion, and shareholder buybacks that make gold miners look like the most attractive stocks on the market. At the realistic successful end, you get something more like Barrick's broader portfolio. Strong margins overall, but constant renegotiation with host governments, rising costs eating into the windfall, and profitability that depends heavily on discipline and capital spending. At the realistic negative end, you get a mine like Loulo Gounkoto in its worst months of 2025, production suspended, $15 million a month burning with zero revenue, gold physically confiscated, and executives facing arrest warrants in a country they've operated in for 2 decades. And at the outright failure end sits the scenario every mining executive privately fears. A government simply revokes the license, expropriates the asset, and the entire investment, no matter how many billions were spent building it, goes to zero. That's the piece that finally reframes the opening assumption. Owning a gold mine was never really about owning gold. It's about owning a temporary, negotiated, and constantly renegotiated right to extract a resource that ultimately belongs to a country and its people, backed by a decades-long relationship with whoever governs that country next: a junta, a democracy, a new administration with a different mining code. The metal is just the output. The actual asset being managed every single day is political trust. And when gold prices spike hard enough to make everyone at the table realize how much value is flowing through that trust, the real cost of owning a gold mine isn't the diesel or the cyanide or the drilling rigs, it's the price of keeping the peace with the one partner who was never actually a shareholder, but who owns the ground the entire business sits on.